How to start investing with $100 4-year experiment results. As a millionaire investor, this is something I get asked all the time. Mickey, what's the best way to start investing with just $100? 4 years ago, I decided to tackle this very question head on. I took a crisp $100 bill and split it 5 ways. Each $20 chunk went into a different investment: individual stocks, REITs, cryptocurrency, gold, and index funds. Today we're cracking open the vault, looking at how each investment performed over these past 4 years. We're going to break it all down on this handy-dandy grid, judging each investment across key factors: ease of learning, passive income potential, tax treatment, risk, and returns. So whether you're starting with $100 or looking to diversify your portfolio, stick around, because this video is for you. Diving into the stock market, individual stocks. Alright, let's kick things off with individual stocks. When I say individual stocks, I'm talking about buying a tiny piece of ownership in a specific company. Think Apple, Tesla, maybe even your favorite coffee shop down the street. If they're publicly traded, of course. The learning curve for individual stocks can be a bit steeper than some other investments. You gotta research companies, understand their financials, and wrap your head around things like price-to-earnings ratios. But hey, that's part of the fun, right? Tons of resources out there to help you get started. Speaking of real money, let's talk about passive income potential. With individual stocks, you can get dividends, which are basically cash payments companies make to their shareholders. Dividends aren't guaranteed and they can fluctuate, but they can be a nice little income stream on top of any potential stock price growth. Taxes on individual stocks can vary depending on how long you hold the investment and your tax bracket. Short-term capital gains are taxed at your ordinary income tax rate, while long-term capital gains are taxed at a lower rate. Individual stocks can be more volatile than other investments, meaning their prices can go up and down like a roller coaster. By spreading your money across different stocks in different industries, you can help mitigate some of that risk. So, after 4 long years, how did my $20 individual stock investment fare? I went with Disney. The pandemic definitely threw a wrench into things, but ultimately my $20 investment grew to $28.50. Overall, I'd say my individual stock investment was a success. Let's move on to the next investment: real estate investment trusts, or REITs. Owning a slice of the city REITs. Welcome back, investors in the making. Let's talk about real estate, that brick-and-mortar giant that's always been a cornerstone of wealth building. But buying a whole property? That's a whole other beast, right? Well, that's where REITs, or real estate investment trusts, come in. Think of REITs as a way to own a sliver of a shopping mall, a chunk of an office building, or even a piece of a massive apartment complex, all without the headaches of being a landlord. You're essentially teaming up with other investors to pool your money and let professionals handle the nitty-gritty of property management. The learning curve for REITs is definitely gentler than that of individual stocks. Start by researching different types of REITs, like retail REITs, residential REITs, or even healthcare REITs. Figure out which type aligns with your investment goals and risk tolerance. REITs generally fall somewhere between individual stocks and bonds on the risk spectrum. They tend to be less volatile than individual stocks, but can still be affected by economic downturns or changes in interest rates. REITs are legally required to distribute a significant portion of their taxable income to shareholders in the form of dividends. This makes REITs a popular choice for investors seeking a steady stream of passive income. When it comes to taxes, REIT dividends are typically taxed as ordinary income. However, there are some tax advantages to investing in REITs through a Roth IRA. How did my $20 REIT investment perform over the past 4 years? I invested in a REIT that focuses on logistics properties. My $20 investment grew to a respectable $26. Overall, I'm pleased with the results of my REIT investment. Next up, we're venturing into the exhilarating world of cryptocurrency. Chapter 3. Crypto Craze, Decrypting the Digital Gold Rush. And we're back. Get ready to dive into the world of cryptocurrency. Cryptocurrency, or crypto for short, is like the rebellious teenager of the investment world: volatile, unpredictable, and full of potential. In the simplest terms, it's like digital cash, secured by cryptography, that allows for secure transactions directly between individuals, without the need for banks or other intermediaries. The learning curve for crypto can feel like climbing Mount Everest. It's a complex world with its own language, technology, and constantly evolving landscape. The key is to start small, do your research, and never invest more than you can afford to lose. When it comes to passive income, crypto offers some intriguing possibilities. You've got things like staking, where you can earn rewards for holding certain cryptocurrencies, and yield farming, which involves lending out your crypto to earn interest. However, these methods can be risky and complex, so proceed with caution. The IRS treats cryptocurrency as property, so capital gains taxes apply when you sell, trade, or spend your crypto for goods or services. Cryptocurrency is notorious for its volatility. Prices can swing wildly in a matter of hours, making it a roller coaster ride for even the most seasoned investors. So, after 4 years of riding the crypto wave, how did my $20 investment fare? I invested in Bitcoin and Ethereum. It was a wild ride with massive spikes and gut-wrenching dips. But when the dust settled, my $20 investment had transformed into $65. The cryptocurrency market is still in its infancy and its future is uncertain. But that's part of what makes it so exciting, right? We've still got 2 more investments to unpack: gold and index funds. So, grab your pickaxes and your calculators as we continue our journey to uncover the best ways to invest $100. Chapter 4. Golden Opportunity or Fool's Gold. Investing in Precious Metals. Welcome back, treasure seekers. Let's talk about gold, that shimmering symbol of wealth and prosperity. From ancient civilizations to modern-day investors, gold has always held a certain allure. When it comes to investing in gold, you've got a few options. You can go old school and buy physical gold like bars or coins and store them in a safe or a vault. Or you can opt for gold ETFs, which are exchange-traded funds that track the price of gold. These ETFs offer a more convenient and liquid way to invest in gold without the hassle of storing physical bullion. The learning curve for gold investing is relatively straightforward. Start by researching the factors that influence the price of gold, like supply and demand, geopolitical events, and inflation. Unfortunately, gold doesn't generate any passive income on its own. It doesn't pay dividends or interest like stocks or bonds. The only way to profit from gold is to sell it for a higher price than you bought it for. The tax treatment of gold depends on how you invest in it. If you buy physical gold and hold it for more than a year, any profits from selling it are taxed as long-term capital gains. However, if you invest in gold ETFs, the tax treatment can be more complex. Gold is often seen as a safe haven asset, a hedge against inflation and economic turmoil. However, it's not immune to price fluctuations. So after 4 years of holding on to my little piece of the gold rush, how did my $20 investment pan out? I invested in a gold ETF. My $20 investment grew to a measly $22. Next, let's explore index funds, often touted as the holy grail of long-term wealth building. Chapter 5. The Lazy Investor's Secret Weapon: Index Funds. Welcome back, fellow investors. It's time to talk about index funds, the unsung heroes of the investment world. These diversified investment vehicles are like the reliable, low-maintenance friend who always shows up on time and never asks for much in return. In a nutshell, an index fund is a type of mutual fund or exchange-traded fund, ETF, that aims to track the performance of a specific market index, like the S&P 500 or the Dow Jones Industrial Average. The learning curve for index funds is practically flat. Simply choose an index fund that aligns with your investment goals, set up a regular investment plan, and let the power of compounding do its magic over time. While index funds don't typically generate significant passive income in the form of dividends, they offer the potential for long-term growth and capital appreciation. As the underlying companies in the index grow and prosper, so does the value of your index fund investment. Index funds are incredibly tax efficient, especially compared to actively managed mutual funds. Since index funds have lower turnover rates, they generate fewer taxable capital gains. This can save you a significant amount of money in taxes over the long run. While no investment is entirely risk-free, index funds are considered to be relatively low risk, especially for long-term investors. By investing in a diversified basket of stocks, you're spreading your risk and reducing the impact of any single stock's performance on your overall portfolio. So, after 4 years of patiently letting my index fund investments simmer, how did it fare? I invested in a broad market index fund that tracks the S&P 500. My $20 investment had grown to a respectable $32. Now, I know what you're thinking, Mickey. That's not exactly a life-changing return. But remember, this was just a $20 investment over 4 years. Imagine the growth potential if you were to invest consistently over several decades. Index funds are all about slow and steady wins the race. By investing consistently in index funds, you're harnessing the power of compounding and setting yourself up for long-term financial success. The power of starting small and investing consistently. So whether you're diving into individual stocks, buying some REITs, exploring crypto, getting into gold, or sticking with the steady reliability of index funds, each investment has its pros and cons. The most important lesson is to start early. Even small amounts like the $100 we've been working with can grow into something significant thanks to the power of compounding. Time is your best friend when it comes to investing, so don't wait to get started. Remember, investing isn't just for the wealthy or the Wall Street whizzes. It's for everyone, regardless of your income, background, or financial goals. The key is to educate yourself, start small, invest consistently, and stay the course. And most importantly, have fun along the way. If you want to know what the laziest way to make money online is, then I'm going to leave that video right up there, but don't click on it just yet. Make sure to subscribe if you want to grow your wealth, okay? I'll see you over there.